So what investor wouldn't like to have just a little more return? Whether you're suffering thinking about the losses from 2022 or watching the great gains in 2023, you're thinking, how do I increase my investment return? I mean, every investor would like to make sure that they're getting as much investment return as possible, given their portfolio construction. And most of us as investors think we should be at least as good as the children of Lake Wobegon, where all the children, or at least all the investors, are above average. Unfortunately, this is mathematically impossible. If we think about the components of return to an investor, really it's the return of the market minus the average cost to the investor. That equals our total investor return. Consider the global stock market. By definition, the average stock investor holds the total global stock market. What do I mean by that? Well, all stocks are ultimately held by all investors. Now, every individual investor may not hold every stock, but combined, we as investors together hold the total market. So the average investor holds the total market. So if we want to be above average, what can we do? Well, one of two things. First, we can try and beat the global market over the course of our investment lifetime. Investors try to do this by holding only those stocks they think will do better than the market, or by trying to avoid market downturns by selling before a decline and then buying before a rally. However, history and research data don't support this as a very high probability approach. The most recent version of the annual SPIVA study, which stands for S&P Indices versus Active, estimates how successful professional active fund managers have been in beating their index benchmarks. The 2022 study shows that over the 20 years ended in December, 96.85% of funds actively trying to beat a chosen U.S. stock market index benchmark, they failed to beat that market. These are highly trained, highly paid professionals. That kind of result should give any of us pause that we think that we have the skill to beat any market on a consistent basis. So if trying to consistently beat the market seems unlikely, what about impacting the second variable, investment costs? The most common costs of investing include transaction costs, where you might pay to buy or sell a stock, mutual fund, or exchange-traded fund, as well as the fees paid to investment managers. For mutual funds and exchange-traded funds, this is referred to as an expense ratio. So let's look at expense ratios first. According to the Investment Company Institute, while the average expense ratio of actively managed funds fell by 0.03% in 2022, at 0.66%, it is still well over 0.5%. For an investor using an index fund to try and achieve the return of the market, their average costs fell 0.01%, 1 basis point, to an average of 5 basis points per year. That is over 0.5% less than the average actively managed fund, and this advantage compounds every year. The average annualized return of the S&P 500 index of U.S. stocks, often referred to as the U.S. market, was a positive 9.8% over the last 20 years ended in December. If you simply subtract the average cost of the average actively managed mutual fund of 0.66% from the return of the market, the hypothetical average return for the hypothetical average investor under these conditions was 9.14%. For the same period, the hypothetical average return for the average investor using an average index mutual fund was 9.75% per year. Now, there are a lot of assumptions here, and no single investor is ever precisely average. But the point that focusing on investment costs can improve the average investor return, well, it just seems to make sense. Recalling the SPIVA study, when you consider that the 90% or more of active fund managers failed to exceed the full return of the market, and that a well-constructed index fund generally does get the return of the market less their low expense ratio, for many investors, a portfolio of low-cost index funds seems like a strategy worth considering to increase their personal return. Shoot, even Warren Buffett acknowledges this is a great strategy for most investors. A couple of other ways as investors that we can reduce our average costs is to consider using exchange-traded funds. Many index ETFs now trade without transaction fees or commissions at custodians like Charles Schwab and Fidelity. Finally, taxes are a potentially large cost to most investors. While not all taxes can be avoided, some can be deferred or minimized by careful trading, as well as using funds that generate little to no capital gains dividends from year to year. Fortunately, many index mutual funds and index ETFs, well, they meet that test. Some costs are worth paying. These can include financial planning, investment advice, and portfolio management that can help you construct and maintain an appropriate portfolio for your financial goals. Studies by Vanguard, a low-cost investment leader, they've estimated that the value of working with an advisor for investment and financial planning advice can save over 1% per year in lost returns due to poor tax planning, excessive trading, and behavioral missteps. And while not every investor can be better than average, like the children of Lake Wobegon, many investors can improve their investment experience by understanding a higher probability way to pursue the return of the market and by lowering their overall investment costs. Finally, this quote, and this is with apologies to Kurt Vonnegut, who wrote it first. In this world, he said, you get what you pay for. What I would add to that is, but when it comes to investing, sometimes what you pay for, well, it's not what you need. Thanks for joining us today. If you have some questions you'd like us to address in the future, you can contact us at the information that you can find on the screen here at www.fostergrp.com. Thanks again. We'll see you soon.